see if this does it. Okay. Let's wait a second for this to connect. Beautiful. Ladies and gentlemen, we are live for another TradingView show. This episode is particularly special because we've got the folks from CME Group here, because there is an epic competition going on right now that many of you are probably seen, called The Leap, and it's sponsored by CME. We're trading CME Group products. And this is a risk-free contest. There are so far 32,000 traders in this contest. It has just started today. You don't have to deposit any money. There's nothing of that sort. It's a paper trading contest, 10 contracts for you to trade. If you can trade the best, you'll get $3,000 cash prize, and there's prizes that just go down the list depending on how you rank. With me is Craig Buick. He's a senior director, client development and sales at CME Group, and he's got 30 years of experience in futures and options markets. Now, this is key to have Craig here because I know there's a lot of you who are new to the Leap, new to trading, new to CME Group products. So we're going to dive into it with Craig, and this is your chance to learn about what's going on, and I think it'll give you a baseline for what it takes to try to come in first place and get that $3,000. So Craig, great to have you here. Maybe if you want to just kick it off with, why you're excited about this contest, and then we can get into the key aspects of CME Group.
Yeah, thanks so much for that introduction, Steph. Even though hearing that I have close to 3 decades in this business makes me kind of want to throw up in my mouth a little bit sometimes, but I do appreciate the introduction, and I'm really excited about this because we've been partners with TradingView for years now, but this is the first time that I've gotten to work with you guys, and it happens to be for this contest that you just described, I think, pretty well, with over 32,000 people already subscribe to the contest. So it's a really fantastic opportunity, I think, for people to sort of dip their foot into what's a future and what does it mean to trade a future, and things like that. So, and as you say, in a contest sort of way, rather than, kind of a live market, with obviously a little bit more at risk. So really excited to do this, and kind of further that partnership that CME has had with TradingView.
Yeah, I have to say one fascinating thing about that, and curious to hear as well with all of your background in markets, is I feel like this type of paper trading aspect is just a good way to get sort of even just educated about markets, right? Because you don't really, there's nothing on the line. You just get to practice. So I don't know if you have any thoughts on that.
Yeah, I think it really is because, obviously with trading futures and trading really any instrument comes risk. And this is a way to sort of in that kind of environment, see what it's like, right? And compete against other people, because it's not easy, right? And we all know that. But people can succeed in it. So I think it really is a very good way to sort of kind of test that out, see what futures are all about if you're not familiar with them. I think, a lot of times people might get familiar with things in the securities world like stocks or even options on stocks before they get familiar with futures. So I think it's a good opportunity to kind of see what that asset class is all about as well.
Absolutely. And now to speak now about the asset class and the symbols that are available in this contest, I feel like now is a good time to sort of dive into the CME Group and what you all do, because first of all, as I understand it, you're the largest exchange by brand value. You are one of the most important players in futures markets. I was just watching futures last night. And so I think this would be a great time for people to learn more about CME Group and why they should, get a good feel for these contracts as they get started in the Leap.
Yeah, a very open-ended question, right? From what is CME Group to why should they care about these contracts? But we'll do a quick, kind of a very quick history. And I got to be careful because I can kind of geek out about this because I think it really is a really fascinating history that CME has, dating all the way back to really the mid 1800s, when the Board of Trade was founded as a grains exchange. And then it was sort of around the turn of the century that the Butter and Egg Exchange, which later became CME, or at the time the Chicago Mercantile Exchange. And then, it wasn't until 1972 actually that a financial future was launched, and that actually happened to be a foreign currency contract. And then, you fast forward to the 2000s, and CME be demutualized, became a publicly traded company, bought the Board of Trade, then it bought the New York Mercantile Exchange, then it bought a company called Next, which got it into the cash business, cash bonds and cash currencies, and really has evolved into this global marketplace where, I think, as you mentioned, as the tagline goes, where the world comes to manage risk. But really a global financial market. And to me, and that was, probably as succinct as I can get on the history of CME, but it is a very storied history, and it's one that, just personally, I've always been proud to be have been a little part of, over the last 30 years.
Absolutely. And now the question is should we get into the presentation that you've prepared for us, or do you think we should dive into the symbols that are being traded in the leap and sort of go through them to explain to traders what these symbols are?
Yeah, why don't we I'm going to pull up a PowerPoint, and I'm not going to walk through every slide, but I think there are some supporting slides for the conversation that we're going to have with respect to some of the products that you're talking about and the products that are available in the LEAP contest. But I think maybe we even take one step back from the products and kind of talk about what is a future, because that's important. If you don't know what a future is, then it's hard to kind of conceptualize what these products that we're about to talk about are. So I'm going to stop presenting this, and I'm going to try to present a slide here.
Great. I think this is a logical next step too, because ultimately the key thing here is to get that base level understanding of what these contracts are. So this is now everyone's chance to understand futures contracts from the sort of foundation of, how they work, what their purpose is, why they're important, and all of that important information. So when you're trading these futures contracts in the leap, when you're going for that $3,000 first place cash prize, you'll now have the foundation you need right here. Craig, take it away.
Yeah, so am I sharing a slide here? Can you see just quite frankly, and I can say this because I made this slide, kind of a boring slide with a textbook definition on it.
We can see it. It looks great. We got it.
Perfect. So, I used to kind of debate with myself whether I even put these first couple slides in the presentation, kind of the 101 presentation. But I tell this story now. Last summer, my son actually was interning here at CME. And one of the first things they have the interns do is a trading competition, internal trading competition. And we were sitting around on the Sunday night that it began, and he logged in from the family room, and I kind of was messing around. I said, sell some WTI crude oil futures. And he said, well, how can I sell something I don't own? And it really kind of struck me that some of these things, some of these concepts that we take for granted, again, as someone who's been doing this for 30 years, aren't necessarily intuitive. So I've got the first couple slides in because I think it's important to emphasize that what a futures contract is, it's simply a contract, right? And that's opposed to a stock or an equity that conveys a right of ownership, right? So we know that if you buy the common stock of a company like Apple, then you own a very, very small percentage of Apple, the company. With a future, it's simply a contract. So that's why, to sell a future, you're simply just entering in essentially to a contract with the entity or the person that's buying that. So, it's like I said, it's kind of a textbook definition, but I think it's important to point out that that's what a futures contract is. So I have another slide here, just a real simple comparison of futures versus equity. So like I just said, an equity represents an ownership in whatever that company is that you're purchasing the stock of. A future does not. A future expires, and we'll get into that where an equity does not. Futures have inherent leverage or capital efficiencies, and we're going to get into that in a second as well. Both trade on an exchange, and there is a subtle difference in kind of what that means in futures versus equities. But I think for these purposes, we'll say that both trade on an exchange. Futures have nearly 24-hour access, right? So most CME products begin trading 5 p.m. Chicago time on Sunday, and they trade until 4 p.m. Chicago time on Friday, with a 1 hour break every night between 4 o'clock and 5 o'clock Chicago time. And then again, just some differences between futures and equities. If you want to get short or kind of sell a particular market, like an E-mini S&P 500, you don't have to locate that stock like you do in the equity market. So if you want to short a stock, there's a what they call a locate requirement that doesn't exist in futures. There's also no borrow costs if you want to get short a particular market in futures. And then the way that they're priced is different. Futures are priced in what we call ticks, and we'll get into that in a minute, where most equities are priced at 1 penny. So I'm going to stop there and just see if there's any questions before I move on to the next slide, which is some of the characteristics of futures, or why you might consider trading futures.
So no questions, just context, because TradingView's actually been working quite hard to get tick charts on our platform. It's been up for quite a while now, but I think that alone will make this presentation really interesting, especially walking through the tick aspect versus the increments in equities at 1 cent. And yeah, very, very interesting, especially the near 24-hour access. And for shorting, there just seems to be quite a few benefits compared to if you're accessing another market like equity. So continue. This is great.
Yeah, and in fact, and I'll concede this idea of ticks versus price is simply something that people that are trading futures have to learn. And it's not difficult to learn. It's just not intuitive. So it's one of those things where you spend a little bit of time, you figure out what we're talking about, and then I think it becomes more second nature. So it's just a difference, and we'll get into that in a minute. But, and I'm not going to go over all 8 of these things here, but I want to touch on a couple of them particularly. So let's start with what we call capital efficiencies, right? And again, like I said before, another word for it, and I'm going to be quite frank, is leverage, right? So with a future, you can basically get exposure to whatever asset, whether it's a stock index, whether it's WTI crude oil, gold, an interest rate, whatever it might be. And CME offers futures in 7 different asset classes. You can get exposure to that product or that market at a sort of fraction of the price. So, as an example, one of the most popular products that individual traders trade here at CME Group is what we call the micro E-mini NASDAQ future. And that's a future that essentially gets you exposure to about $40,000 worth of NASDAQ 100, the NASDAQ 100 index. But for that, we only require that somebody posts about between 5 or 6% of that $40,000 to hold that position overnight. So it's essentially this idea of making your money go a long way. And at the end of the day, whether you're a global hedge fund, an international bank, a central bank, or an individual, at some point, I think most of us are capital constrained. And so this use of leverage in futures is really an efficient way to use your money. Now, I will point out that can be a double-edged sword, because with that inherent leverage comes the necessity. It requires that you be a good risk manager, because as you get more exposure than the money that you need to post, there is inherent risk in that. So trading futures is a very capital efficient way to use money, but it does, like I said, require you to be a disciplined and strict risk manager in your trading. So I'm going to stop there actually before I go to the next one.
No, I think that's one thing that's sort of a timeless lesson in markets is risk management. And so anytime I hear that in these types of chats, I'm immediately saying excellent, because those educational ideas as well on TradingView tend to do well. Like when someone writes a post about risk management on TradingView, it tends to get lots of boosts, lots of comments. So I'm all ready for you to dive into that as well. And I see you have this margin slide up, and I know even with the leap there are some margin aspects. So let's get into it.
Yeah, I think it's probably a good time, and then I can go back to the other slide. But just because we're on the topic, I'm going to fast forward to this. So actually, I'm going to go back one more slide. So when we say margin in futures, it's a little bit different context than when we talk about margin in equities. Because when you talk about trading on margin in an equities account, what you're talking about is essentially you have to put up by what they call Reg T. It's an SEC rule. By Reg T requirements, you need to put up at least 50%, or you have to put up 50% of the exposure that you're getting in whatever security that you're trading. So, and the balance of that 50% comes in the form of a loan from your broker. And that's a loan that you pay interest on. When we talk about margin and futures, we're really talking about a performance bond, or essentially a good faith requirement that you put up. So it's not, I want to make a contrast here between margin and futures and margin and equities, where the margin that you put up in futures is a performance bond, says I'm good for this position, but it's not a loan. And on this slide, it says 4 to 4.5% currently. Kind of depends on, that's for equity index products. It depends on the volatility environment that we're in, and different products have different margins, and we can get into that. But at the time I did this slide, it was about 4.5% of the notional value, and we're going to get into that right here. So at the time I did this slide, the NASDAQ was trading a little bit less than it is now. I think it's more around $20,000 now. But I've got that futures contract that I mentioned before, the micro E-mini NASDAQ. And at the time I did this slide, it was the price of the NASDAQ was about 18,590. Futures have a multiplier, and that's how we get into the ticks. I'm not going to get too much into it now, but the multiplier for the micro NASDAQ is 2. So essentially what that means is, to calculate how much exposure you're getting to the NASDAQ, you would take that price of 18,590 and multiply it by 2 to come up with about $37,000 worth of NASDAQ exposure. Now, again, today at about 20,000 at the price of the NASDAQ, that's about $40,000 worth of NASDAQ exposure with one contract. Now, to hold that overnight, CME's at the time I did the slide, CME required about $1,800 in performance bond or margin requirement. So you can see, to hold $37,000 worth of NASDAQ, you're putting up less than $2,000 in margin. And that's what we mean by capital efficient. And that just kind of preserves your other capital to deploy elsewhere. Now, if we contrast that to a similar position in, for example, the QQQ, which is going to be very highly correlated with the micro NASDAQ 100 in terms of price, if you wanted to hold a similar amount of notional exposure, you'd be required under Reg T margin requirements to put up nearly $20,000 in margin. Or to put it another way, so I did this slide, I think, before NVIDIA split. At the time, the share price of NVIDIA was trading at about $450. So again, to hold that same amount of notional exposure in NVIDIA as the micro E-mini NASDAQ future, again, it would require almost $19,000. So you can see, just this is what we mean by margin, or by capital efficiencies, is this, again, this idea of inherent leverage that we're talking about, that I hope is clear on this slide.
I'll say it is clear, and it's just the red numbers that you have there are hard to miss, essentially. To see the margin requirement on the CME contract as compared to the margin requirement, say, for the QQQ, that alone caught my attention right away. So that is that's rather fascinating, I have to say. And curious to see what slide you have for us next, because I had a question about the contracts listed there, but I don't want to take us, too far off the slides you have prepared.
Yeah, let's hit on a couple of these, and then we'll get kind of more into the contracts.
Okay, great.
But before we do that, I think one of the biggest things with futures trading at CME, and I mentioned at the onset, was that concept of nearly 24-hour trading from Sunday night through Friday afternoon. And I have a slide over here that I think sort of underscores why that's so important. So what I did here was, at the time I did this, and I'm not sure that that this has changed actually, but at the time I did this slide, I took overnight volume only. So I isolated volume to 5 p.m. I think to like 7 a.m. was the hours I used. And I looked back in history and I said, on which nights did we have the largest amount of overnight volume in either the E-mini S&P 500 or micro E-mini S&P 500 or a combination thereof? What nights did we have the highest volume? And during those nights, what was the price range in that particular contract, which in this case is a future based on the S&P 500. So if you look at it, the largest volume we ever had, and at the time it was before we launched the micro E-mini S&P 500. So in 2016, this was E-mini S&P 500 volume. We did 2.3 million contracts of E-mini S&P volume overnight only. Now that was November 9th of 2016. That was that year's presidential election. And if you remember, and I think everybody does, we went into that election and I think the consensus was that Hillary Clinton was going to win that election, and the results kind of started coming in the other way. The price range in the S&P 500 that night was 132 points, which if you translate that to dollars was a $6,600 move just overnight. So if you don't have access to your position overnight, that's a $6,600 per one lot, which means if you have one E-mini S&P on, that's a $6,600 impact to your P&L overnight. And I think that alone just kind of, like I said, underscores why it's so important to be able to get to your position, like in the futures market, all night long. You can see some of the other nights where we had just tremendous volume in these contracts overnight. Back in March of 2023, we had the volatility that was induced by the Silicon Valley Bank failure. In 2020, that was COVID worries. So you can kind of see the different things that sort of precipitated these big volumes. But a lot of times you don't know when these things are going to happen, right? It's not like you can predict where there's some sort of dislocation overnight when it becomes critical for you to be able to get at your position. And in fact, if I go back to that November of 16, the November election, I think it was Carl Icahn kind of gave CME a nice inadvertent commercial because he came out in public and said that he had left an election party that night and placed a trade in the E-mini S&P 500. And he named the dollar amount that he made on the trade. It was like $10 million or something that he made on the trade by placing that trade overnight. So kind of a nice commercial for CME. But I think it does sort of go to show how important it is to be able to get at your position overnight and be able to trade 24 hours a day.
So this slide is awesome, and I just have to say that I can remember all of these moves following markets as much as I do, and in every instance that I was following these moves, I was always using futures contracts to understand what, because traditional, like the New York Stock Exchange isn't open yet, so I have to follow the futures markets to see what's going on. I remember the 2016 election move as well. That was just remarkable to watch that trading action. But I suppose, though, what's so interesting about this as well is that if you do want access, oftentimes, to these types of moves, you have to literally, like, futures is the only way. Otherwise, I've always found then I wake up the next day, the gap up's already happened on the S&P, on the SPY ETF or VO. The gap up's already happened up or down. But futures give you access, to these moves before the equity markets might open. And I see that quote there at the bottom, and I have to say that's where that 24-hour access is so interesting. And this is a great slide.
You're absolutely right, and especially as the world, the global economy has become so much more interconnected, probably than it's ever been. It's not. They used to say when the U.S. sneezed, the world caught a cold. Now it sort of kind of doesn't matter who sneezes, right? What happens in the States affects what happens in Asia, affects what happens in Europe, and around and around. So anything can happen anywhere in the world, and some of this is predictable, right? Like we knew that the election was happening on that night. We didn't know that Silicon Valley Bank, was going to come out with that news. And we knew back, if you go back to the beginning of 2020, there were stories about COVID and then there were some cases in the States, I think in January and stuff, but like nobody knew that night was going to be the night, that something happened, some news of it. So a lot of times you don't know what what's going to trigger these volatile, this or induce this volatility into the market. So, I think we've sort of said enough, but, I do think, that is one of the sort of tenets of futures. It's very important.
Absolutely. And how about the aspect of, oh, interesting. Yes. What's the Oh, okay. That ticks versus prices slide is pretty interesting, I have to say. But keep walking us through this deck. This is great.
Yeah, so I'll go through these other ones really quickly. They're the ones I want to hit on. We talked about the ease of going short, and and I think that is material. And certainly, as as we have a real interest rate now, I think it becomes even more important, right? Because those borrow costs become material in that securities world. Whereas if you want to get short in futures, you simply sell it. If you want to get long, you buy it, and it's really that simple. At least in terms of execution. There's, I'm not a tax accountant. I'm not going to give tax advice, but in certain situations, there are tax benefits to trading futures over other asset classes. One of them I
Interesting.
want to hit. I'm sorry, go ahead.
Oh, is there an example of that? That's quite interesting.
It has to do with whether, if you're holding a security short term, the rate that you get taxed at versus if you hold a future short term, it's called the 60-40 rule. And again, I don't want to get too much into it because I'm not a tax accountant, but I would encourage, it's a simple Google search, and I would encourage anyone that's listening to just check out, the tax implications of trading futures under the 60-40 rule.
Great. Yeah, that's really interesting. I was not aware of that. So mental note, and if anyone's listening, 60-40 rule, check it out. Go give it a Google search.
Yeah, I would absolutely do that. We've got a note on here about pure direction, and I think this one's important, then we'll move on. But what we're talking about here is, let's say you want exposure to the crude oil market. You have a view that the price of crude oil is going to go up or going to go down, or whatever your view might be. Well, you could get that exposure in several different places. You could buy the stock of a energy company. You could do ETFs, or you could do futures. And what we like to say is, what's more correlated to the price of crude than crude, right? And that's exactly what you're trading. If you trade crude oil futures at expiration, that's going to be the price of crude. So it's a very, what we call, pure play on a given market.
Oop.
So if there's no, yeah, so if you don't have any questions on that,
No,
let's actually
no questions.
move on.
I actually thought I lost you for a second.
Oh, no, I stopped to see if you had if that was clear.
Yep, no, totally clear. Let's keep it rolling, because there's a few questions I'm pretty anxious to get to, especially around contracts and ticks.
Yep.
But all ears for now, and anyone watching this as the leap gets kicked off is going to be getting that walkthrough.
Yep.
That
Are
maybe
you there? I feel like you cut out at the end. Can you hear me?
Yep, I can hear you. Oh, Craig, hey.
Yep. Did I lose you there?
Yep, you lost me for a second.
All right, I think I'm back now. I think I might have had an unstable internet connection, but let me, I'm back now. Can you hear me?
Oh yeah, you are back loud and clear.
Perfect. All right. No, I think you're absolutely right. I think it's time to get into what are these things, right? So I talked about the notional value, and that kind of goes in to the tick value that we keep talking about. So, and it happens that the example that I have is the same one that I used in the other slide. So again, this is what we call the micro E-mini NASDAQ 100 future. And the way, and I explained it quickly, but the way that we come up with the notional value, or in other words, how much exposure you're getting to a particular product, in this case, the NASDAQ 100, is you take what we call a multiplier. For the micro E-mini NASDAQ, that multiplier is 2. Multiply it by the price, you get the exposure, about $40,000 at the time I did this slide. Now, if we were to look at crude oil, the multiplier for what we would call the standard size crude, or the bigger of the 2 contracts, or bigger of the 3 contracts, as it were, you would take 1,000 barrels of crude. So the multiplier is 1,000 times the price of crude, which I'm not sure what it is. Let's say it's $75 right now. So with 1 contract of crude, you would be getting $75,000 worth of crude exposure. For gold, the standard size contract is 100 ounces. So you would take 100 ounces times the price of gold. So that's how we come up with what we call the notional value. But in layman's terms, the way I like to think of it is, how much exposure in dollars are you getting to this particular contract? So I'm going to stop there just to make sure that makes sense.
It does make sense. And the other aspect too that I would be very interested to understand is the difference between, say, so for example, when I'm looking at the symbols in the contest, we have the E-mini S&P 500 index futures, as well as just the standard S&P 500 E-mini futures. So I'd even would love to get into the slight name changes too, and in relation to how much you're getting with each contract.
Yep, I think it's a really good segue into this slide, and it's a very good point. So to kind of, I guess, revisit the quick history lesson that we had at the beginning of the presentation. Traditionally, we actually had a bigger S&P 500 future, which didn't have the E-mini in front, and I believe the multiplier on that was 500. I believe it was 1997, CME introduced what we called the E-mini S&P 500, which was essentially a futures contract based on the S&P 500. The notional value of that was and is 50. So the multiplier on the E-mini S&P is 50 times the index value. So at the time in 1997, I don't know what the S&P was trading at, but it was a much smaller number than it is now. So the notional value kind of really was a mini, if for lack of a better term. If you fast forward to 2019, the price appreciation of the S&P 500, was such that when you multiplied that by 50, in a lot of ways, that was no longer a real, quote, mini product. It was a large product that gave a lot of exposure. So what we did in 2019 was we launched what was called the micro E-mini S&P 500, which was 1/10 the size of the E-mini S&P 500. So instead of multiplying the current price level of the S&P 500 index by 50, you multiply it by 5 to get the notional value. And what that does is it changes the value of every price increment that we have in that product. So just to back up a second, if you were to look and again, at the time I did this slide, the E-mini S&P 500 was trading at around $5,500. So you see on the right there, at the time I did this, the bid on the E-mini S&P 500 was 5532.25. The ask was 5532.50. That's what we call the minimum tick increment. So you've heard us say tick a couple of times. That's what we mean. So in futures parlance, we might say the E-mini S&P 500 ticks in quarter points. That's that 0.25. So no one can get in between that 32.25 at 32.5. That's the smallest difference that can exist between the bid and the offer. Now, what that 0.25 means is, in dollar terms, is $12.50. And the way we get that is we apply that multiplier of 50 times 0.25, which gets you to $12.50. Or in other words, if you were to buy the E-mini, again, at the time we did this, if you were to buy this at 32.25 and sell it at 32.5, the impact to your P&L would be $12.50. Again, minus fees and commissions and all that. Now on the micro, because it's 1/10 the size of the E-mini, instead of $12.50, we're going to multiply that 0.25 by, instead of multiplying 0.25 by 50, we're going to multiply that 0.25 by 5, which equates to $1.25 impact to your P&L in dollar terms, right? So if you're trading one contract of the micro and you're able to sell it at 0.25 higher than you bought it, the impact to your P&L is $1.25. If you're trading the E-mini, your impact to the impact to your P&L is $12.50. Now I'm going to stop there because that's a lot, but it's one of, and this is what I mentioned before. And actually before I stop, I'm going to compare it to the stock world, right? Where if you buy what they call a round lot of a common stock, I'm going to just say Apple. If you buy 100 shares of Apple, and Apple moves up by $1, well, it's pretty intuitive that the impact to your P&L is $100, right? 100 shares, $1 per share. The impact to your P&L is $100. This is what I was talking about before with futures. It's not necessarily intuitive if you just look at 0.25 to know that the value in dollar terms is $12.50 or $1.25. But it's one of those things that you just, and I'm just going to concede that you just have to learn in futures. And once you do, I think it becomes second nature. So now I'm going to stop, Steph, and I'm going to let you comment or ask me to clarify anything that might not have been clear there.
The first thing that comes to mind for me, and maybe for a lot of people watching as well, is so the difference between the E-mini and the micros, you can really see it on this slide, especially in the value tick column. But who do you think is the type of trader that would, like, why would they pick one over the other? What type of trader sort of falls into the E-minis or the micros?
Yeah, it's a great question. And, I think what the micros did, when you think about it, so the multiplier in the micro is 5. And at the time I did, I think the S&P is probably closer to 6,000 now, but at the time I did this, the price of the S&P was around $5,500. So the notional exposure, or how much exposure you're getting to the E-mini S&P 500, is either 5 for the micro or 50 on the E-mini. So let's look at the micro. So let's multiply 5,500 by 5 and we come up with something like 27,500 or something like that. That's 27, or let's say close to $30,000 worth of exposure to the S&P 500 with one contract. Now, if you're trading the mini, it's 10 times that. So almost $300,000 worth of S&P exposure with one contract. So I think what the micro done was allowed people that wanted to trade futures and wanted to get exposure to these major US equity indexes through futures, but didn't want 300, or in the case of the NASDAQ, $400,000 worth of exposure to those indexes, and allowed them to get into futures at, quite frankly, a more manageable size. So I would say, to answer your question, we have a lot of individual traders who trade the E-mini S&P 500 at 300, close to $300,000 per one lot. We have a lot of individual traders who trade the E-mini NASDAQ 100 at close to $400,000 per one contract. But we also have a whole lot of customers, a lot of individual traders that trade those micros, because the other thing the micro does is it allows you to what we call scale into a position. So let's say you're somebody that has the risk tolerance, the capital, the risk appetite to actually get exposure to $300,000 worth of S&P 500 exposure. What the micro does is allows you to either scale in or scale out of that position. So maybe you are someone that, has a view on the S&P 500, and you buy one E-mini S&P 500 contract. You get long one contract. And let's say the market moves in your favor. Well, in the absence of the micro, the only choice you'd have if the market moved in your favor would either be to hold it and sort of hope that it kept going in your favor, or to sell the whole thing, sell the E-mini. What the micro does is it allows you to get out of that position gradually. So if you put on, let's say you bought one E-mini and it went up, you could sell, 2 or 3 micros. Now you have, let's say if you sold 3 micros, you'd essentially have the equivalent of 7 micros left, or 7/10 of an E-mini. And because maybe you had a core view that it was going to continue higher, but you wanted to take some risk off. So not only does the micro allow people that don't want that $300,000 or $400,000 worth of exposure to get into the futures market, it also gives flexibility to people who are, like I said, do have that risk appetite or risk tolerance and capital to be able to trade a mini. So that was a very long answer to your short question. I would say in general, you're going to get the institutional business is going to gravitate more towards the E-mini, whereas individual traders, I would say, are trading both the E-mini and the micro E-mini. And when I say institutional, what I mean by that is sort of the end user customer. in all of our markets, we have what are called liquidity providers or market makers who are essentially always providing a real-time bid and offer. That's kind of their job, is to provide the bid offer at all times in all of these different products. So I'm going to stop there because I know that was a lot.
It was fascinating. I think my favorite aspect is the element of scaling in and out with by combining the contracts. Did I understand that right? You can actually combine them when you're say if you mentioned where you can use the e-minis to sell a portion, the micro e-minis to sell a portion of maybe your e-minis. Did I have that correct?
Yeah, and again, I want to be careful about the word combine, but essentially because both products are essentially going to settle to the same price when the future expires, and we can get it. Actually, we actually should get into that just for a couple minutes here. What happens when a future expires, because they do have expiries on them, as opposed again to a stock that somebody might be trading. So I want to be careful about combine, but if you are long one E-mini S&P 500, it's essentially the same exposure as 10 micros. So if you were long one E-mini S&P 500 and you sold 3 micro E-mini S&P 500s, you would actually, both positions would be on your books. You'd essentially be long the E-mini and you'd be short the 3 micros. But in terms of exposure, it would reduce your exposure to 7/10 of what I might call 7/10 of an E-mini. So it wouldn't necessarily combine them, but it allows you to sort of gradually take that risk off, if that makes sense.
It does. It's really interesting. Not many markets offer that type of capability. It's usually just sort of, like one name that you're trading, not different contracts related to that same exact name. And you mentioned the expiration. I also really want to discuss expiration, because if someone is trading in the Leap contest, going for that $3,000 first prize, and maybe they hold crude oil until expiration. I mean, it's just paper trading, so not really. But does that mean they have to accept a ton of barrels of crude oil at their front door or not? This is one thing that I think a lot of people do ask about often.
I think it's one of the things when I do like industry shows or shows with brokers and things like that, and we're sort of answering questions from individual traders. It may be one of the most common sort of comments I get from people who aren't that familiar with futures is that, oh, I don't want to trade futures because I don't want an oil tanker showing up in my front yard, as you just said. And obviously, that's a little bit facetious, but it is worth pointing out that some of these products that we're talking about, even on the slide in front of you, some of them are what we call cash settled products, and some of them are indeed physically delivered products. So I'm going to start with the cash settled products, which is what the stock indexes that we've been talking about are. It's actually what the micro crude oil contract is. So a cash settled product, if a product is cash settled, it means that if you hold that product until it expires, on the last day, we're essentially just going to mark the price wherever that particular product settles on that day. We're going to do one final movement of money, and then it's going to go away. So let's just say your only position in the market was long one micro E-mini S&P 500, and you bought it 2 weeks before that future was going to expire, and you bought it for 55.32 and a half, like what's on the screen. What we're going to do is essentially we're going to mark your position every day. It's called mark to market. Again, it's one of the sort of essential tenets of futures trading. So every day, if the market goes in your favor, your accounts, you were going to sort of credit your account. If the market moves against you, we're going to debit your account. You're going to have to put up margin for that. But every day we're going to mark your position to market. On the last day, we're going to do one final mark. If you made money, your P&L is going to reflect that, and the position is going to go away, and you'll be flat in the market. So you will no longer have a position in the S&P 500. On a physically delivered contract, like the regular size WTI crude oil. Now, first of all, I'm going to say that if you're an individual trader trading at most of the, what we would call retail brokers, they're not going to let you get that close to delivery because either they don't have or don't want to go through the mechanism that it would require to actually take delivery of 1,000 barrels of crude oil, and it would be very expensive for them and for you. So if you were in fact long or short a futures contract in WTI crude oil and you got close to expiration of that, it's likely, very likely, that your broker would be calling you, sending you emails, and ultimately, I think, probably close you out of that position before it expired. Now, if something happened and they didn't, that actually does go to delivery. So if you're and institutions use that all the time. If you might be an energy company or whatever, whatever you're using, that you're an institution that's hedging risk with WTI crude oil, maybe you actually want delivery of that, or maybe you want to make delivery. That actually does happen when that future expires. So as a retail trader, an individual trader, you really want to pay attention to the date on which that futures contract expires, because there is that element of delivery. Now, again, in reality, it's most likely your broker is going to get you out of that one way or another. They're going to ask you to get out of it first, or they're going to probably get you out themselves. Now, there's two ways to get out of these contracts before delivery, or before they expire, I should say. So let's actually go back to the E-mini S&P 500 contract, which is cash settled. Let's say you bought it and you were holding this futures contract and you were getting close to the expiration of it, but you wanted to maintain that long exposure to the S&P 500. There's a very simple mechanism that we call rolling the position, which is really nothing more than a simple spread trade. So what you would do is, let's say, it was, what are we in now? February. So let's say you're holding the March S&P 500 contract, and we got into March and it was nearing the expiration day in March, and you wanted to maintain that exposure. What you would simply do, and you can do this in one transaction, you would simply sell the March future and buy the June future. And again, we have market makers, those liquidity providers I just mentioned, that are providing a spread price, or essentially the difference between the March and June price, that would allow you to do that in one simple transaction. And if you did do that, you would simply then cease to be long the March and you would be long the June future, and you'd be able to maintain that long exposure to the S&P 500 index. Similarly, if you were long WTI crude oil and you were nearing expiration, you wanted to maintain that long exposure, you would simply do the same thing. You would sell the month that you were long, and you would buy the next deferred month that you wanted essentially to maintain that long exposure in. So again, I'm going to stop there because I know that was a lot again.
It was a lot, but it's super insightful because of the number of people who are just learning this for the first time. So the physical contract and the cash contract, if people want to learn more about which contracts are which, they can find that probably on your website. Would that be right?
Yeah. So all of these futures contracts, what we have what we call contract specification or contract specs. And the slide that I just put up is essentially an excerpt from our website of the contract specs of the micro E-mini NASDAQ 100. Now, there's a lot that goes into a contract spec, and I kind of highlighted in yellow what I thought was critical. It's all important. I highlighted what I thought were the critical elements of the contract spec. One, the top one, which is the notional value, or how much exposure you're getting. The trading hours, when is this open? Like I said, most of our products start 6 p.m. Eastern time on Sunday, and they trade until 5 p.m. Eastern time on Friday with a 1 hour break, but not all of them. So that's another important element of the contract specs. You want to know what the symbol is for that product. So let's say you're on the TradingView front end and you want to look at the micro NASDAQ. Well, you want to know how to find that. So we have different, kind of like a stock has a ticker, futures contracts have the commodity code, which in this case would be MNQ. I know a lot of futures platforms will have a /MNQ, or however you might find the future, but you want to know what that contract code is. And again, how many listed contracts or how many expirations are there? Well, for the E-mini or the micro and the E-mini NASDAQ 100, they're quarterly contracts. So March, June, SEP, and DEES. For something like crude, I believe I think we have a contract every month. But so again, each product can have a different listed or expiration cycle. So you want to know that. And then that next slide there is exactly what we're talking about. So these are, I called it cash settled on the contract spec here. We call it financially settled, but that's as opposed to physically delivered. So cash settled, financially settled is what I was describing. The alternative is a physically delivered contract. So these contract specs are important. Like I said, I highlighted in yellow what I thought were the real critical elements of it. They're all important, but that's where you can find them, and you can find them on, on CME's website, on CME's app. They're pretty much readily available for someone that wants to learn about each given product.
And in terms of because you mentioned the different contracts quarterly or with crude oil, I think you said monthly. Maybe just give us a quick background on how to think about that. So I'm even looking at the crude oil contracts on TradingView right now, and I can see that or futures, March 2025, April 2025, May 2025. Maybe just walk us through how, if we're new looking at that list of different months, how to think about, what that's showing us.
Yeah, it's a great question. And again, it's one of these things that I sort of sometimes can take for granted, having been in futures for so long. But I do see how it can be confusing if you're someone that's new to futures. And again, this is one of those things that you really just kind of have to learn on a product by product basis. So if we look at our equity index futures, like the S&P, the NASDAQ, the Russell, the Dow, those are going to have quarterly expirations. And within those expirations, most of what we call the liquidity or the volume is going to happen in what we call the front month. So right now in the beginning of February, most of the action in the NASDAQ or the S&P or the Russell or the Dow is going to happen in that next expiring month, which is March. And then maybe a week or two before March expires, you're going to start to see activity both in March and in June, which is what we call the roll that I mentioned. So you'll start to see people moving positions from March to June, and then you'll just sort of start to see June activity pick up. But most of the action, the volume, the liquidity in these stock indexes happens in that front month. Now that's different than something like what you mentioned, crude oil or nat gas, or some of our agricultural products like corn, wheat, beans, which have a seasonality, essentially a seasonal impact to them. And I think it's most easily understood if we look at the nat gas contract, where a lot of the action in nat gas, because it's used for heating, can happen in the winter. So what you'll see is during the winter months, those contracts can get very, very active. But even before you get to those months, you can see activity out what we call the futures curve as people try to sort of position themselves for what they think might happen in the heating, and then to a lesser extent, the cooling months, but particularly in those heating months. So as opposed to the stock index futures, in like nat gas futures, for example, you can see activity in several different months out the curve, even up to like a year out. Similar to that might be the grains markets, where there's this concept of what we call old crop, new crop. So old crop is what we call the grains, if you will, that are sitting in a silo somewhere, where new crop is essentially the crop that's in the ground. So again, people will sometimes spread the difference in old crop months versus the more deferred in the calendar new crop months, because it's essentially a play on how much will be harvested, how good the harvest is and things like that in different grains versus the supply that exists in the silos. So it's a great question. And, unfortunately I can't kind of go over every single product, but it's something that I think every user should take a look at when they're looking at different futures. Look at where the volume is, because you can pull up all the different contract months. And if you do that, you'll see that in things like stock indexes, even in things like treasuries, most of that volume is going to happen in that, what we call nearby or front month. But if you pull up something like nat gas, grains, some of the short-term interest rate products that we have here, not the treasuries, but the shorter-term interest rates, you'll see activity that goes what we call out the futures curve. And that'll tell you where the volume is. And then it will be up to you to do your research on, why someone might be trading a deferred contract month versus the front month. And, we can get into it in a bit, but CME has a ton of educational resources that speak to some of this stuff on the different products.
So the nat gas example, I feel like really just clicks for me, which is, let's say, correct me if this example is wrong. Let's say it's August and there's some sort of report that we're going to have one of the coldest winters ever recorded. Everyone's now saying this winter is just going to be absolutely freezing. You then could probably, I'm not saying it's guaranteed, but it's most likely, go look at the natural gas futures contracts in, say, January, February, March, and they'll have the most volume because they're sort of getting ahead of this really freezing winter that may require a lot of natural gas. Is that a way to think about it?
It's very close. So they may not have the most volume, but as opposed to like the stock indexes that we've been talking about, where you're going to see really not a ton of real small volumes as you move out the curve, you're going to see viable trading. You could see viable trading volumes in the Dece, Jan, Feb, whatever it might be in that gas. And that's exactly right. As people try to position themselves, if, for example, the forecasted winter in the United States is to be colder than normal or colder than expected or things like that. So that's exactly right. And that's why you can get volume kind of out the curve in that, whereas in some of these other products, it's really concentrated in the front month. That's it. It's exactly the way to look at that.
And for all of our listeners as well, I just think it's important that I do read out the symbols in the Leap contest for futures, just so that everyone has a good understanding of what they are able to access. You've got CL1, MES1, NQ1, MBT1, which is Bitcoin, MCL1, M6E1, MGC1, MNQ1, GC1, and ES1. So you've got a really nice mixture of equities in the S&P 500 and NASDAQ 100 contracts. MBT is crypto. You've got crude oil. And I think what's really interesting is there's gold and there's the euro. So pretty diverse selection of assets for everyone to access as well. And ideally, this conversation has really helped you start to understand what it is you're trading and how to, approach them when you open up that first chart, join the Leap, and go for that $3,000 first place cash prize or any of the other cash prizes. Because even if you come in second, $1,500, third place is $1,200, fourth place is $1,000, fifth is $800, and the list goes on. So, Craig, maybe there's a few more slides you want to take us through, and then I think we should wrap it up and perhaps plan our next chat about this excellent contest.
Perfect. Yeah, no, this has been my pleasure, and it's been great. You just mentioned all the different products that are available in the Leap contest. And I think that's one of the important things about having an account to trade CME products is the diverse asset class or the diverse product suite that we do offer, right? So, you mentioned a lot of these things in front of you are part of this contest, but, with futures, with an account to trade futures and CME futures, you can trade equities, metals, energies, ags, rates, FX. I've got cryptocurrencies listed under equities. I'd almost call that the seventh asset class at this point. So within, the sort of CME umbrella, you can get exposure to all these different things. And the reason I think that's important is because they're not all correlated with one another. So sometimes you might get into a trading environment where, you're seeing a very low volatility environment, let's say in stock indexes, but there's a lot of activity, there's a lot of price movement, for whatever reason, maybe in the WTI crude oil markets. And at the end of the day, most traders, most individual traders, proprietary traders do like volatility, right? That a lot of times presents opportunity. So with this diverse asset class, this asset class diversification, as we call it, there's a sort of a higher likelihood that one of these asset classes might have a volatility environment that somebody wants to trade. And, we have a lot of tools on CME's website, but here's one that we call the cross correlation tool, I think. And this is available for free on CME's website, but the green boxes essentially are products that are highly correlated with one another. The red boxes are products that are negatively correlated with one another. So you can see, there's not all of these products go up when the other one does. There's some that are very highly correlated, and there's some that are actually negatively correlated. And I think this speaks to why it's so important that you're able to trade all 6 or 7 of those asset classes here at CME.
Absolutely. Absolutely. Because I think this even takes us back to some of the things we started the chat with, which was about even risk management. And there's an element of risk management there. If you can build a trading strategy or sort of this portfolio that has that level of diversification, or maybe you're hedging because of the negative correlations, really interesting stuff. And I'll say this, Craig, we made it this was an hour-long chat. Time seemed to have flown by, I must say. I was checking, thinking maybe we're like 30 minutes in or so, but we are an hour in, and I think we covered the basics for all of the traders into the leap. I just want to say one thing that I find rather amusing that I was telling Craig before we've started is there are about now I think 33,000 traders in the leap. We're coming up on 34,000. I haven't placed a trade yet, and I am in 17,568th place. So pretty interesting that essentially there's a perfect like 50% have lost money on the first day, 50% have made money on the first day. Also, I was looking through the leaderboard just quickly. Craig, you'll find this fascinating. There are 4 people who are already up 100%. I don't,
Wow.
I mean, that's like kind of remarkable for a few hours. It's just, whoa, 100% literally just started. So anyways, the leap is on. There's a tradingview.com, the leap. It's under the community tab, tradingview.com/the leap. The leap is sponsored by CME Group. And, make sure you go join because there's a chance to win some cash prizes just for jumping in and giving this contest a try.
Yeah, I mean, how exciting is that we have 34,000 people register for this contest? Like, to me, that's awesome. And, again, I'm glad that I got the opportunity to do this. I want to thank TradingView for that opportunity. Like I said at the onset, we've been great partners. I hope this is the first of many of such things that I get to do with your group. And of course, I want to thank everyone that tuned in and spent a little bit of their day with us. I know we all have busy lives, so it's not lost on us that you took some time out to listen to what we have to say today. And before I end, I do want to point out the slide that's in front of you. CME has spent considerable resources to build what I would consider a world-class educational portal called the CME Institute coursework. And I don't think that there's ever any such thing as knowing too much about what you're trading and about the products. So I would encourage everyone, whether you're just getting into it or you're a seasoned vet, to go check that out.
Fantastic. And just curious, what is, before we head out of here, just because I'm looking at it like, how that is remarkable. Oh, well,
I think I lost you again. Now am I back?
you're back. Yeah. Did you hear the final question about the traders being up? So there's technically 5 traders up 100% on the first day. And before we head out of here, I just wanted to see if you have, I don't know, a comment on that or like just, I don't know, anything. I mean, that's remarkable to me.
I mean, that's awesome for them for sure. And it's a great start to the contest. In some ways, I'm more interested in, the comment that you made before that being, at even about halfway on the leaderboard. Because the last thing I'd want to do is make anyone think that this is easy, right? And trading requires discipline, it requires work. But I think, the people that are up in the contest and people that have figured out in sort of the live markets are testament to the fact that it can happen, right? But it's not easy. And it does require that strict discipline, that risk management, and everything else that goes along with it. So, and like we've talked about, I think the contest is a great way for someone to kind of stick their toe into some of this and get a feel for what it's like, and so I think that's the comment I would make on kind of the overall leaderboard rather than, congratulations to anyone that's up 100%. That's awesome. I hope it continues to be higher than 100%, and keeps going up. But yeah, that's kind of what I would say about that.
Fantastic. Well, Ladies and gentlemen, thanks for tuning in to this special show with CME Group all about the leap. And as mentioned, make sure you sign up. You've got, I believe, about 2 weeks left to join the contest. So go get in there, get a chance to win some of these prizes. And we will see you soon with some more content about the leap and as well about the futures markets and everything that's offered to you through CME. Thanks so much for joining the live stream. And Craig, we will see you later. And also, thanks for joining us.
Yeah, like I said, my pleasure, and thanks very much.
Great. Okay, we will see everyone later.